Hello, hello, hello. The time has come. Nick is here. Welcome to the show, man. How does it feel to be Nick today?
Feels pretty good. Thanks for having me, Brett.
Man, absolutely. Feels really good. Where are you at right now?
So I'm based in Denver. So you got
Denver.
gorgeous sunshine and no snow, at least in the future for a little bit, but hopefully in the high country.
Yes, we're recording this just before Thanksgiving here. So happy Thanksgiving. And it's not snowing yet. Is it usually snowing by now?
You know, it's so funny. People think that Denver's a really snowy spot, but we're a desert climate. So I literally have cactus in my yard, and so you can see the snow coming in the high country. And we'll get tons of snow in the mountains, but here in Denver, you get an inch of snow on the ground, people lose their minds. It's very different for them.
That is crazy. Yeah, from the east side of the states, I'm in Carolinas. I just think of Denver. I think of snow. So it doesn't relate that you have a cactus in your yard. That's crazy.
Yeah.
Hey, let's get started by letting the listeners know just a little bit about you. So get to know you a little bit better and tell us about your journey from professional MMA athlete to venture capitalist. What a spread.
It's a big spread, but I've been blessed enough to have people open up doors for me, and I guess I've had just the smarts enough to walk through them at the right time, and so it actually kind of overlays perfectly with kind of my past. So for me, like you said, I was an athlete. MMA had a great, successful career there, but I knew I couldn't, frankly, get punched in the face my entire career. It's not a sustainable, life choice. So you have to transition out of sport. And so for me, I'm a physiologist by trade. So I went from MMA to then working with NFL, NHL teams right out of the gate in physiology and trying to give back to those in sport. And interestingly enough, when I was there, it was that connection point between what I experienced being a professional athlete, as well as then working with pro athletes, all the cool things that everybody gets to work with when you're at that level. But the general population just doesn't see it, and they're not aware of it. So I really got set on this path of commercialization of how do we expand intellectual property, get it out to the masses? How do we scale this? How do we, work to basically take things and bring it to the general populace? And so from there, as team physiologists, I started working a lot with orthopedic surgeons, family practice physicians, and started to kind of grow. I formed different SPVs, helped them on clinical workflows that kind of dovetailed into sports medicine, all the way to then taking myself into the founder seat, where I tell everybody I've had a successful exit and I've also had to VK a company. And so when you have both ends of the spectrum, you have a really good, clear picture where, I will say there's a lot of charlatans out there who will say, hey, I exited one company and I got $200 million from it. Follow me for the insights. It's like, no, I don't need your winning lotto ticket numbers, man. You want to be battle tested and see exactly how things work on the good and the bad end of the spectrum. And so although it was very trying during that time, blessed to have the experience and kind of come through the other side of it. After forming different SPVs, I worked with physicians to help them open up large clinics, acquire clinics, flip into a REIT. Everything that I touched has really been in the sports, the medical, or the hospitality and real estate lanes. And so continuing on that path, I then became an LP in different funds, an angel investor, to ultimately being an investor myself and being in the VC game. What's nice about it is liquidity points. I think if, physicians are going to go in there and they're looking to own their practice and they're owning the building within, it's kind of I don't mean this in a condescending way, but it's a McDonald's model. Right? If you own the real estate and you own the operations within it, it's far more fruitful. And so the process of flipping it honestly was not as difficult as it sounds. But the reality is it takes time. It takes time, it takes thought process of how and when you want to have an exit. So I would say this for anybody who's looking at that and trying to grow into that area. Making sure that when you set up your cap table, set up your initial capital coming in, that you're stacking it in such a way that you're thinking of your exit in mind. If this is a physician who wants to practice for the next 20 years, great. You know your time horizon of where you're going to be, and maybe you could sell prior to that. If you know that this is a physician group who wants to probably sell to a PE group or a local hospital in the next 5 years, stack the same thing for your real estate in that direction.
Interesting. I want to mention too a little bit about Champion Venture Partners. Can you tell us just a brief introduction of what that is, and we'll go from there.
Yeah, Champion Venture Partners is where I'm at today, and it sounds weird to say, but it's kind of the culmination of everything that I've worked on in my past. So at CVP, it formed with two partners of mine, a gentleman named Jeff McDermott, who has a past history with working within funds and also teaching emerging managers how to become fiduciaries and run venture capital funds. My other partner, Marcus Colston, he played in the NFL for the New Orleans Saints for, I think, just over 10 years. Marcus and I met, we'll call it pre-COVID buddies. I actually probably need to track it back to the exact date. But we met over a sports tech company. And from there, we really started designing and talking about the lack of meaningful ownership for athletes in sports. And what's funny, I think about the same thing as physicians. It's the same thing of owning in what you're practicing, right? If you look at the majority of physicians practicing out there, they're not owning in their own private practice. So if you look at kind of the entire trajectory, you really started to say, all right, how are we going to make meaningful ownership in sport for athletes? As we were designing, we said, we don't want to do a traditional venture capital fund that's a 2 and 20 model where it's 2% interest, 20% carry. We didn't want to tax our investors that way. We wanted to be equally yoked with our investors and put our money to work. So the natural segue to that then was to create a holding company versus a true fund. Out of that holding company, we own an RIA and we own a management company. Those two things create revenue for us to turn around and invest in what we have actually made called an interval fund, which is a first of its kind sports asset class fund where retail investors can invest alongside the biggest names in sports. So the great thing about this is you don't have to be an ultra high net worth individual to own and part of the sports assets. You can own with literally $500 coming in. So the great thing about this is we've opened up the sports asset class, but we invest across the entire sports asset chain. So what I mean by that is we're looking at the stadiums, we're looking at the short-term rental facilities around that, we're looking at the offices around it, we're looking at the medical teams that are providing the teams, CPG products, sports tech, the entire thing that really constitutes what sports asset is, not just like owning an NFL team. Everybody thinks that right away. It's literally all the great stuff connected to it. Everything we do, we want to make sure that we're giving back to local community too. So we're very hyper-local and hyper-focused on everything that we invest in. And the reason why I say that is because we interconnect our portfolio. So let's say we invest in an emerging league and team. Then we want to look at the stadium around, and I've kind of said this already. And then we want to look at, what's happening in the ecosystem around there. We will look at how can we give back to the local community because part of our cap table, we have a nonprofit involved as well called Buys and X. We're able to give back to our local communities through that nonprofit by way of the returns and things we generate. But then also on top of that, we look for ways to kind of plant our portfolio companies. So let's say we have an equipment company. We want to find a way to get back to like some of that sports equipment to underserved, underprivileged children that are in that area. That not only helps elevate our brand, but it's doing right by others. So it's an absolute win-win all around. Number one is identify a North Star. You have to do it at the onset of the business. You have to make sure that it's there on the onset of your investment, the onset of whatever you're trying to do. I think people too often are like, ooh, I want to make a lot of money. Here's how I'm going to do it, invest. No, you don't. That's not true. Money is a tool. It is a byproduct of doing the right thing. And it also is a tool for freedom, for financial freedom. It is not the end game. So you need to connect with your super why and whatever that North Star is for you. So for instance, mine is my family. And I want them to, in the future, want for nothing but have to earn everything, a desire to earn and a desire to get out there. And so that's my North Star that makes it so that I want to lead by example. I want to work hard so that my children see that, so that they have that same work ethic of earning it and working hard. Same thing now for anybody investing in business. If you just sure want returns, yeah, I can't help you there. But if you want to make returns by way of, I want to make returns in real estate because I want to pop up more affordable housing, awesome, let's talk about it. If you want to make returns inside of real estate because you have a passion for giving access to people on the ski slopes and housing lifties, great, there's a way to do that. So everything has to come back to a certain purpose, otherwise you're just shooting from the hip, and frankly, you'll never get long-term wealth. I think there's on-the-nose monitoring of your shares, the growth on the net asset value of each share you have, you're growing your principal and kind of where things go. I think kind of a common mistake is people don't ask, what does deal flow look like? The quickest way that, in my opinion, is the death of a fund is that there's capital to deploy and people don't know where to deploy it, so they start to birdshot into risky deals or they start to place it in things that don't work. So a question people should ask is, what does your deal flow look like? how are you getting to the top 1% of deals, and why should I put my money with you? So if you're asking, how do you get that deal flow? How are you staying on top of deal flow, staying on top of all the markets over and over? How do you stay advanced? That is what people should be asking.